we are! Welcome to the exciting world of leverage, where fortunes can be made and lost in the blink of an eye. Leverage is like rocket fuel for your portfolio, allowing you to control much larger positions than your account balance would normally allow. It's the ultimate tool for ambitious traders looking to supercharge their profits. Imagine this: you have $1,000 and you want to buy Apple stock, but wait. With leverage, you can borrow money from your broker and control a much larger position, say $10,000. That's the power of leverage. It lets you amplify your buying power and potentially rake in massive gains. But hold your horses. Leverage is a double-edged sword. While it can magnify your profits, it can also amplify your losses. Remember, leverage is borrowed money, and if the market moves against you, those losses can quickly snowball into a financial disaster. So, before you jump headfirst into the world of leverage, buckle up and let's break down how it works in both traditional and crypto markets. In traditional markets, leverage is typically offered through margin accounts. Think of a margin account as a special type of brokerage account that allows you to borrow money from your broker to buy stocks, bonds, or other assets. Let's say you want to buy 100 shares of Apple stock, currently trading at $150 per share. That's a cool $15,000 investment, but with a margin account and a 50% margin requirement, you only need to put down $7,500 of your own money. The remaining $7,500 is loaned to you by your broker. Now, if Apple's share price jumps to $160, you've made a tidy profit of $1,000 on your 100 shares. That's a 13.3% return on your initial $7,500 investment. Not bad, right? But here's the catch. If Apple's share price plummets to $140, you've just lost $1,000. That's a 13.3% loss on your $7,500. See how leverage can quickly turn against you? Now let's dive into the wild world of crypto leverage. In the cryptosphere, leverage is often offered through derivatives like futures and perpetual contracts. These contracts allow you to speculate on the price of a cryptocurrency without actually owning the underlying asset. Here's how it works. You can open a leveraged position on a crypto exchange with a small amount of margin, often as low as 1%. So, with just $100, you could control a $10,000 position in Bitcoin. That's some serious firepower. But remember, with great leverage comes great risk. The crypto market is notoriously volatile, and prices can swing wildly in either direction. If you're on the wrong side of a leveraged trade, those losses can quickly wipe out your entire account. Section 4. Benefits and risks. Amplifying gains and losses. So we've seen how leverage can be a powerful tool for traders in both traditional and crypto markets. But like any tool, it's important to understand its benefits and risks before you start swinging it around. The biggest benefit of leverage is obvious. It can amplify your gains. By borrowing money, you can control larger positions and potentially make much more money than you could with just your own capital. This is especially appealing in fast-moving markets like crypto, where prices can skyrocket or plummet in a matter of hours. However, the flip side of this coin is the amplified risk. Leverage magnifies your losses just as much as your gains. A small move against you can quickly turn into a significant loss, potentially wiping out your entire account. Section 5. Margin, liquidation and risk management, navigating the leverage landscape. Now that we've covered the basics of leverage, let's delve into some key concepts. Margin is the amount of money you need to put down to open a leveraged position. Think of it as a security deposit for your loan. Liquidation occurs when your losses exceed your margin and your broker automatically closes your position to prevent further losses. It's like getting a margin call, but in the crypto world, it happens automatically and much faster. Risk management is crucial when using leverage. This includes setting stop-loss orders to limit your potential losses, diversifying your portfolio and never risking more money than you can afford to lose. Section 6. Tread carefully, understanding the perils of leverage. Leverage can be a powerful tool for savvy traders, but it's not for the faint of heart. Before you even think about touching leverage, make sure you have a solid understanding of the risks involved. Remember, leverage magnifies both your gains and losses. While it can lead to outsized returns, it can also wipe out your entire account in the blink of an eye, especially in volatile markets like crypto. Before you jump into the world of leveraged trading, ask yourself these questions. Do I fully understand how leverage works? Am I comfortable with the risks involved? Do I have a solid risk management plan in place? If you answered no to any of these questions, then steer clear of leverage. It's better to be safe than sorry, especially when it comes to your hard-earned money. Remember, in the words of the great Warren Buffett, rule number 1, never lose money. Rule number 2, never forget rule number 1.